Good morning. Velocity in options trading and puts not working. Those are our topics today on Options Brew TV Traders Workshop. Hello, Mark. Good morning. How are you?
Lex, good to see you, man. You know, I'd come to you from anywhere here.
I was going to say, now, clearly, have to have a comment on the backdrop. I know that's a fake backdrop. It's not real. You're in some studio, and you picked the Southern France background, right?
Right, and wanted to put the Hemingway hat on just for the effect, of course.
Yeah, so you're in some cool place in France, I can see, drinking probably really good wine.
Really good rosé.
Nice. I love it. I love it.
You can throw a dart at in this country and find good wine, though.
Yeah, that's true. That's a good point. You've been over there for over a year now, so it was going to be a year, but then it's a year and a half or something, right?
That's a rough measure. It's we'll see how.
We'll see how it goes. All right, what's new? Let's see. Let's take a look at the markets. Let me do that. I saw that they were up early. So, yeah, the Dow. We don't care about the Dow so much, but it's up 450 points-ish. NASDAQ down about 29, 20, and S&P's up 16. What's with the NASDAQ? There's a little disconnect right now. Is it all these, Microsoft Meta earnings that are pulling that baby down?
Yeah, I mean, the Meta earnings, I didn't dig too much into the specifics there, but they got whacked. I mean, I think I saw them trading down as much as 25, 28% pre-market. I think stock dipped under 100 at one point. So my top line read was that they are just blowing through money in a lot of this VR headset play. That the whole Meta, directional shift in the company strategy has just been expensive and non-revenue producing at this point. Combined with the fact that advertisers are fleeing, right? So they've got cash going out the door and less coming in.
So I just looked. It's around $100 a share, which is today it's down 24% from on the earnings call. That's significant, obviously. I don't know how Mark Zuckerberg is going to do with $20 billion less, but that's significant. That's a monster move from where it's been too. It's been significantly higher, this stock. Right.
Oh, and I think the company themselves, they were buying back tons of shares when it was trading in like the 350 zone. They spent, tens of billions on buybacks when this stock was much higher. And now it's trading, like you say, around 100. And they've got some serious cash flow problems. So their investors aren't going to be happy about that, right? When your strategic shift isn't working and your old play isn't working either.
Yeah, no, that's a puppy downer. I bet your puts are working in there. We'll talk about that in a second. No one said anything. Yeah, go ahead. Sorry.
I was just going to say, I didn't see what the straddle was coming into it, but I'm betting you like the long straddle on this play. Usually in a name like that. Oh, yeah. I mean, a 20% straddle in Facebook would have been high.
I think it would be high. I don't think it was priced there. I really don't. But you never know. I wish we had looked at that. We should have taken a peek. No one says anything about the guy standing behind me. I was on a 5-hour show yesterday, and
you put a head on that guy.
There's a dude standing behind me. Yeah, and I didn't get one comment on the dude standing behind me. It's Halloween. This is our Halloween edition. It's coming up. I know adults don't get into Halloween so much. I kind of do. I don't know.
That doesn't surprise me. You're a very festive guy.
Yeah. So anyway, but no, it's Grimley. He's kind of the butler. I put my trading jacket on him and a NikkiClothing.com hat on it. So anyway, okay, let's talk about a few things. We got the markets. I was going to talk about velocity, what that means, and you were going to talk about puts. Maybe we can do a little of both. Okay, should we tackle velocity first?
Yeah, let's get into this because you brought this up pre-market or pre-show, and I'm curious about your definition because it jives with some things we used to think about.
Okay, so the way we looked at velocity, okay, and it's not a standard indicator. Okay, it's sort of one we made up back in the day. Okay, and when I say made up, it has some scientific background to it and some mathematics. But in broad general sense, what we measured was these were 1-minute candles that we looked at, and this is about the extent of my technical knowledge here. Is we measured when a 1-minute candle movement was 3, 4, and 5x of an estimated ATR in a candle. So we could measure what average true range move in minute candles. So we had that mathematics and that data going back a long ways. And then when we got a 5x move in that candle, it told us something about A, hedging, and B, potentially, is it a breakout or is it an actual retracement? And think about the difference, right? So breaking out makes sense. Some news came out, and this thing's going crazy, and it's going to go through to the moon, or conversely to the floor if it's bad news. Or someone on the institutional side said, "Hey, I need to buy 10,000 calls," and everyone got out of the way, and every one of us market makers hedging the hell out of it, and the stock takes off. So that the trick was, what do you do with the data? And we've humbled and fumbled around with it a little bit, but we could measure velocity. I thought it was a good measure. I always liked seeing it. I didn't always know what to do with it though, but I don't know if you have any thoughts on that. It's probably pertinent to how we market making communities hedge too, right? It might have a little tail into that.
Well, yeah, exactly. It's always about discerning, like you say, the signal in that order flow, right? Is this someone that's just an indiscriminate buyer that's taking or creating a liquidity pocket, and all of a sudden we're going to revert back down? Or is this actually like new information entering the marketplace? Does someone see the equity is cheap and is buying this because it's going to rip up? And to your point, I think we thought about this most in terms of how we would hedge any deltas that you had on your book. Less so with deltas from gamma, positional deltas. I think you generally kind of hope this is going to be mean reverting. But if you saw one of these kind of breakouts or fallouts, when you had a delta that you were hedging from like a live trade, so you just sold those calls in the pit. If you were trying to get rid of some of those like new deltas that you put on, how aggressive you were chasing those really mattered, right? You didn't want to be the one bidding that stock up too and chasing it all the way to the top to see it revert.
Right.
And everyone had a different style for how patient they wanted to be, and how probabilistic you wanted to be about, is this going to return? Is this not? Should I buy half? And so, for us, it was an algorithm question and tweaking the parameters on the algorithm for how aggressive you were going to chase those.
Yeah, those are all good points. I think what we found mostly from our statistical analysis of the data is that it tended to be a reversal or a retracement. It was what you just mentioned. Someone had to have something in a big way, and people ran away from it, and it tended to mean revert, the movement. So it might not, but here was the problem. It wasn't that it mean reverted right away. You could have a big candle, a 5x candle, and then chop, 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 and then run up again, chop, 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 run up again. And then, minutes later, you might get that reversion back to some mean. So it was, yeah.
We definitely noticed that with our own flow, right? Like even if you're trading an illiquid stock, sometimes you're the candle and you're trying to prevent it from humping up too much, right? And so we would look at executions over 30 minutes or an hour or whatnot and say, how can I give the least amount of hump in my execution, right? Like I want to bring my sort of like diversion down, so I'm not the one creating those candles.
Yeah. Yeah. I think, yeah, exactly. So for the retail trader, right, I think what we're going to do with TradeHawk ultimately is we're going to give our users the ability to create this velocity signal. Okay. It's not right around the corner, but we're going to do it because we already have the technology for it. And I'm going to start looking at it a little bit, because what you can do in the retail world is you can have the technology to see this happen, and B, you can make a trading decision. It could be a spread, right? You could say, hey, if this happens, sell a call spread, sell a put spread, right? Or something, of the like, right? It may be a pretty good trade idea generator in a more of an automated fashion, right? So
that's exactly what I was going to say. Is that like it's a perfect like signal for putting on a spread or a probabilistic. Hey, we broke out. Maybe now's the time that I sell this call spread, and if it reverts, great, I cash. But that's a kind of higher probability signal if you've moved like that to. It's a great opportunity to enter into something like that, because sometimes it goes one way, sometimes it doesn't. You're never going to know, but your odds kind of shift when it has made a move like that.
Yeah, absolutely. So yeah, we'll come back on that one. when we get that in. But it's pretty interesting. Maybe you can do like a little in-out spread, which is a Don Kaufman term. He's a one of our partners at Tradier, and he's a big in-out call spreader or put spreader for that matter. And all that means is one strikes in the money, one strikes out of the money. Pretty close, and you kind of negates theta, negates gamma. So it's a sheer dollar play with one of those. I thought it was interesting. He gave a little presentation on our show yesterday on our summit that I found very fascinating, and he explained it mathematically. So we should tackle that one of these days too.
I like that. That's a good term. I haven't heard that before, but right, it balances most of your Greeks out. So you're playing with kind of cash pure numbers, like intuitive odds.
Yep. Yeah. It was. Yeah. I'm going to go back and listen to his explanation. It was very good. He's very good at his product is Theo Trade. So he did a really great job with it. So I want to go back and listen to that one. Okay, the other topic we had today is when puts underperform. Maybe I'm not saying that right, but when puts are like lead weights. And I certainly know from my days on the floor, we have the long downside puts on occasion and short upside calls. We somehow get ourselves into that position. Was not often, but we would. And that draggy down move, it was like pulling a monster up a hill, more or less. Those puts just wouldn't move. So you had some comments on this concept. What do you have?
Yeah, I think that's been one of the really confounding things about the last couple of months in the market here, right? Is that we've been in this sort of, and we've touched on it a couple of times. We touched on it last week with this sort of like persistent elevated vol environment where, we've been trading at a reasonably high, 30 plus VIX for, I think, something like 20 plus days now. It's the fourth time this year. That kind of backwardation in the markets has existed for longer than usual. We're seeing this interesting term structure because of call sellers and put sellers. And like all of this is creating kind of some weird vol markets. And even puts aren't performing because they're so darn expensive. And that's like, I think a simple, naive explanation for why that works, right? When the VIX is 30, your puts are expensive and the market's moving about as much as those are costing. So long equities, long puts, like that's just not a trade that's paying right now because the cost of insurance is very closely related to the realized delivered vol experience of that insurance. Right. So, and I think, as you mentioned, right, like you used to see this all the time in individual names where you felt you had these puts, you had these downside protection, but they're just lead weight because of the price of them, because of the theta, because of the grind out of them.
Yeah. So there's two things working with that concept, right? The first one is what you mentioned is just sheer implied volatility being high, right? So that has an issue. Okay. The second part of that is it goes with high volatility is the downside skew could be steep as well, meaning puts are much higher implied volatility than calls. So you've got two things potentially working: high implied volatility at large and a steep skew where your puts are more dear than the calls than normal, right? So that's when you got the old double whammy. And it's interesting because yesterday Jason made a comment that when implied volatility is high, realized volatility may be even higher, and implied generally isn't high enough, which I thought was interesting. I'm not sure I agree with it, and I wish you were here today to tell me about it. But I don't know how you feel about it, but I get his point a little bit. And he said the converse on the other side: when implied volatility is low, it's probably not low enough because actual realized volatility underlying is even lower. So,
well, and that was the experience we had all through 2021 is the markets were just grinding higher. Actually, to add on a third point to your things for why they might not be working, this is sort of what we saw peaking towards the end of 2021. And I recently saw a note from Ben Eifert at QVR Advisors, who is elaborating on this, and credit to him for the idea. But the spot vol covariance, so the relationship between the spot price and what implied volatility does, particularly on like a fixed strike. But you're used to seeing market up, vol down. And last year, it was the epitome of that we just kept grinding higher and vol was like even lower. I think VIX was trading in the upper teens, but we were seeing realized numbers in the low teens, even high single digits, right? It was that Vol's just even going lower as the market's going even higher. I mean, the short vol, like long delta butterfly, was the best trade you could have on last year. But it's completely flipped now. And after peaking this spot vol covariance levels, the highest levels of correlation, they've actually gone negative. So it's another thing that's kind of contributing to this perception of why puts aren't working, because we see days where the market's rallying and vol isn't coming in, and vol's actually going up because people are expecting the next downside rally, right? So you know, we're not seeing the same sort of relationship mechanics in the spot and vol markets that, you know, we leaned on for years prior to this, the regime prior to this, I should say.
Sure. So, you know, the one of the common comments yesterday in the summit was that implied volatility at these levels is here to stay for a decent time. Do you agree with that? And you know, that's certainly a macroeconomic view of things. I'm assuming people say that because, you know, what's going to happen in Russia, Ukraine, inflation, border, you know, there's all the things that are kind of giving us sort of stress in market volatility. Seems like people are saying that it's going to be out there for the foreseeable future.
Yeah, and like I think, you know, in a lot of ways, a lot of the kind of doomsayers, bears, whatever you want to call them, are, you know, still predicting another big dropout in the markets. Yeah. And, you know, many of the previous, whether it was 2020, 2008, you know, 1989, like you can go back in market history and talk about all these big crack events where VIX is really peaking. I don't think we necessarily need to see that in this market, right? I think we could have a very persistent medium high volatility regime, VIX in the 30s, where we kind of chop around aimlessly, you know, concerned about inflation, concerned about the value of the dollar, concerned about oil, all the macroeconomic factors you pointed out, right? That could lead to some medium grade chop without any single big event, you know, for the 6, 12, 18 months even.
Yeah. No, that's a good point. All right. I think we're
makes it tough to position.
Yeah, right.
It's a tricky market to position for.
It is. I think, you know, option traders, though, they're in a good position because of the nature of an options product. It's you and I would say it's generally a great product for volatility. So the more chaos and mispricing there is, the better our advantage, right? As an options trader. I just, you know, the worst days of my life in my trading career were always the sunny July days when nothing was going on and I probably had the wrong position on and couldn't get out of it. And I'm like, this sucks, you know, as opposed to crazy volatility. Even if I had the wrong position on, you got activity and you had misprices, right? So
yep, you collected edge, you were transacting, you were moving inventory. I mean, no, I totally agree. High vol environments present tons of opportunities, you know, whether they're butterflies for cheap, you know, looking, you know, you don't necessarily need to do the traditional hedges that we talked about. Like high vol creates really interesting spread opportunities, especially with options. So no, it's definitely not something to sleep on. It's definitely a capital preservation environment, but you know, tactically positioning yourself for a move, the options are gravy for that.
Yeah, undoubtedly. Okay, good. So I asked a question yesterday on the summit. You know, we had these giveaways and I was giving away these shirts and some money for their accounts. And one of the question was, which option spread doesn't fly? And I gave them the iron condor, the butterfly, the seagull. What do you choose?
Well, I don't. I was going to come up with something clever like a jelly roll, because it just.
I like the jelly rolls don't fly. You're right.
They certainly don't fly.
I think a butterfly. We know a butterfly flies. We know a seagull flies. I think an iron condor might glide if it can jump off a cliff, but I don't think it really flies. It might not be a flying bird, but I could be wrong about that.
I'm not aerodynamically inclined enough to answer the difference between flying and gliding.
Okay, I got you. Anyway, no wrong answer. You got yourself put into the lottery to win the shirts. So we have a new sponsor of shirts. It's let me see if I can get it in here. It's called NikkiCClothing.com, and you know they
gave us where your hat is from.
Yeah, the hat back there is from NikkiCClothing.com as well. I used to have a little thing in here. Hold on. Okay, I can't find it. How am I doing? Here, watch this. You ready? I'll get this sooner or later, Mark. You think I'd be prepared for this? Here it is. NikkiCClothing.com. And by the way, options 20, you always receive 20% off on your whole order. No, anyway, it's great clothes. They, really soft and very colorful. But nevertheless,
I can't wait to see these shirts. They're bird theme or flying theme, I hoped.
Yeah, that's exactly right. That's why I used that question. I'm going to get you one in your favorite color. Don't you worry about a thing. We got all kinds. We'll talk about that.
My favorite color is rosé.
Oh, I have one like that. Perfect. Did you notice the outline of our show here? It's fall maroon, kind of like a deep rosé, I guess.
Oh, seasonal. Yeah. I did.
It's very seasonal. So, all right, brother. Well, listen, I'll let you go. We're getting to the end here. Good talk. You have a great weekend and rest of the week. All right.
Well, and as Jason would say, since we missed him, I know he'd say something about keeping your hedges on.
Yes,
so in his honor, happy trading and keep your hedges on.
All right. I'll talk in a little bit.
All right.
See you, Mark.